Welcome to The Explainer. Today, we're jumping right into the natural life cycle of an investor. It's a continuous journey, tying together time, strategy, your own psychology, and eventually decumulation in retirement. Whether you're just throwing in your first $100 or getting ready to draw down a massive portfolio, there's a hidden architecture to how wealth actually works. So let's trace that roadmap together. So think about this. What is the absolute greatest asset you have as an investor? You might instantly think capital, right? Or maybe insider knowledge, or a crazy high-paying job. But as the research clearly shows, your biggest superpower literally isn't money at all. It's time, teamed up with the absolute magic of compounding.
Which brings us right to the starting line, the magic of compounding.
To actually measure that compounding momentum, we use a super elegant little mental framework called the Rule of 72. You just take the number 72 and divide it by your expected annual return. The result? It tells you exactly how many years it takes for your money to double. So, if you're getting a 10% return, your money doubles in about 7.2 years. You don't need some massive, complicated spreadsheet to see your financial future. You just need this simple math.
And to really visualize how this exponential growth plays out, let's look at the 8-4-3 rule. Basically, this breaks a 15-year investment journey into 3 distinct chunks. In step 1, those first 8 years, you're just laying the foundation. It feels incredibly slow, maybe even a little maddening. But then step 2, the next 4 years, the pace suddenly picks up. And step 3, those final 3 years, pure rapid expansion. Your wealth grows faster in those last 3 years than it did in the entire first 8. It really goes to show how early, painstakingly slow progress inevitably explodes if you just stay consistent.
Let's put that into perspective. Imagine investor A starts investing at age 25, puts in a total of 50 grand by age 35, and then, boom, stops completely, never invests another dime. Then you have investor B, who starts at age 35 and invests a total of $150,000 by age 65. Now here's the crazy part. Investor A often ends up with significantly more money by retirement age. Seriously. Despite contributing barely a third as much. Why? Because investor A's money had a 10-year head start to compound. Like we said, time does the heavy lifting, not your wallet.
Now, moving smoothly along our timeline, we enter the next phase, the journey, navigating horizons and strategies. See, you absolutely must align your strategy with your actual timeline. For short-term investing, so goals under 3 years, like saving up for a house down payment, your focus is 100% capital preservation. You want high liquidity and safety. Think CDs or high-yield savings. But on the flip side, for long-term investing of 10 years or more, your focus shifts entirely to growth. Here, you're leaning heavily into assets like stocks because you have the decades required to recover from those inevitable, stomach-churning market dips. As we start building out that long-term growth portfolio, we hit a massive fork in the road, active versus passive management. Active management is all about frequent trading, trying to time the market, and paying higher fees to managers who are constantly trying to beat the averages. Passive management, though, that's the classic buy and hold strategy. It relies on time in the market using simple, low-cost index funds.
Now, what's really interesting here is the data. Over a 14-year period, it turns out that simple, low-fee, passive funds actually beat actively managed strategies by roughly 5 percentage points. 5%! That is a massive margin over 14 years. When you factor in the high fees of active management, the boring, passive approach actually delivers a way more reliable path to long-term wealth.
But strategies only work if humans can stick to them, which brings us to the human element, psychology and risk.
To really understand why investors so often sabotage themselves, it's absolutely vital to separate 2 completely different concepts, risk capacity and risk tolerance. Risk capacity? That's just math. It's your financial ability to take a risk based on your balance sheet and timeline. But risk tolerance? That is entirely emotional. It is your psychological willingness to stomach volatility. For example, a young wealthy investor might have the mathematical capacity to lose half their portfolio, but a bad Tuesday in the market might reveal their emotional tolerance is actually 0, and they panic sell at the worst possible moment.
And interestingly enough, our inherent personality traits heavily influence these choices. Looking at the Big 5 personality traits, researchers found that high levels of openness to experience, conscientiousness, and extroversion strongly push investors toward short-term, highly liquid investments. So your high extroversion might actually make you crave short-term liquidity over long-term discipline. It's wild to think about, but your innate personality is literally shaping your portfolio structure.
Add to those personality traits our common behavioral biases. We suffer from loss aversion, where losing a buck hurts twice as much as gaining a buck feels good. We fall for framing and hyperbolic discounting, basically choosing small, immediate rewards over massive future ones. And most dangerously, overconfidence. Because let's be honest, we all secretly think we're smarter than the market. These short-term emotional reactions can completely override our rational plans and push us right into impulsive decisions.
Assuming we manage to survive our own psychology, we finally reach the finish line. Rethinking retirement glide paths.
This is the decumulation phase, right? Where the goal shifts from building wealth to making sure you just don't outlive it. Now, for decades, conventional wisdom has pushed us into traditional lifestyle or target date funds. The strategy is essentially a glide path that slowly transitions you to safety. 10 years before retirement, you're heavy in high-growth equities. On retirement day, you're balanced. And 10 years into retirement, you're heavily concentrated in super conservative bonds and cash. The whole idea is to protect you from a sudden market crash right when you stop working. However, let's contrast that traditional path with a contrarian approach, the reverse life cycle glide path. Recent academic analysis proposes doing the exact opposite of what we've been taught. Instead of decreasing your equity as you age, the reverse life cycle actually increases your exposure to equities as you move through retirement. I know, it sounds totally crazy and incredibly risky at first glance, right?
But the data reveals a massive truth bomb. Contrarian reverse strategies consistently outperform traditional portfolios in generating terminal wealth. Because traditional funds shift so heavily into low-yield bonds, they severely limit your upside potential over a 20 or 30-year retirement. Increasing your equity later in life actually yields higher terminal wealth, and it gives you a significantly better chance of sustaining your pre-retirement income without running dry.
Which brings us to a really powerful quote from the researchers. The dependence on the target date fund approach creates an illusion of security in retirement. Because these traditional funds purposefully limit your wealth's growth potential to achieve lower volatility, they might just be a comfortable illusion. They make you feel safe in the moment, but mathematically, they aren't necessarily the safest bet for funding 3 whole decades of your golden years.
So, as we wrap up this explainer, I want you to take a hard look at your own portfolio. Look at the fees, your time horizons, and your glide paths. Ask yourself, is your financial roadmap actually driven by an optimal long-term strategy, or are you just paying for an illusion of security? Understanding these mechanics is the very first step to taking real control, and hopefully we've inspired you to find out exactly where you stand.